We have just received a triple beat on December's inflation report. This now firmly puts Jerome Powell on the back foot, and in this video we're going to discuss what he now must do. He literally does not have a choice. We're going to cover off exactly what happened, the market response to what is going on, because some people are feeling the market response is subdued. We're going to cover off exactly why, but let's kick this off by understanding exactly what happened. Headline inflation came down from 7.1 to 6.5, exactly as expected. Core inflation came down from 6 down to 5.7%, exactly as expected. The month-on-month figure came in at minus 0.1. Yes, a deflationary month. Okay, now a deflationary month. Very powerful, exactly as expected. This is a triple B, and this is an amazing CPI report to kick off 2023. So the question now is, why is the market not simply exploding? A lot of people, when we were doing our live stream, when the data was released a couple of hours ago, go check that out, you will see that a lot of people were disappointed we didn't see big movements in the market. But before the data came out, I warned of exactly that. The market has already priced imperfection. There is very little room for error here on the CPI reading, and I think it's going to be like this for the next few reads at least. The market has come into this year expecting CPI to meaningfully come down, and that is why you're seeing such aggressive expectations. Had we have missed them, had CPI come in at 6.6, 6.7, there would have been a painful correction here in the market. You would have seen a big rejection here from this neckline. Now that the data's come in, that's good news. We could have easily missed it. So let's take it as positive, and let's see now where should this be heading from here, because what's more important is what's going to happen from here with the FOMC meeting just 2 weeks away. Jerome Powell will now firmly be on the back foot. Let's take a look here at the Fed rate monitor tool, and this is going to shock you. This is something I've been warning about for the last few weeks. We saw that 20%, up to 20% of the market was pricing in a pause. Now after this CPI reading, and I know this is quite like emotive because this fluctuates a lot and it's just happened, the CPI reading has just come out, but 35% almost of the market is expecting a pause. So what that CPI reading has all but done here is confirm 25 basis points. There was still, this thought in my head that maybe Jerome Powell's going to be stubborn and come out with 50 basis points. After that reading, he has very little choice. He needs to come out and deliver 25 basis points, and now 35% of the market is even expecting a pause. Who would have thought coming into this year that the first FOMC meeting we would have priced in a third probability that we could be pausing our rate hikes? Now, even if you don't assume we're going to pause at the next meeting, which I personally don't think we're going to see a pause, hopefully we now see 25 basis points. What about the next meeting, right? Because now we can say, okay, there's meaningful avenue for maybe getting 25 basis points, getting to this range, which is the 4.5 to 4.75, and then just pausing. And that is what this situation is here. That is what 60% of the market now expects to happen. 25 basis points at this meeting, and then on March the 15th, we could be seeing a pause. Really good news to start off 2023. CPI is in check. Remember, I did share with you guys that when it comes to CPI, the market is priced in perfection. They do not see CPI as the bother this year. The bellwether and the focus of the market, it was CPI last year. This year is the labor market. They know that what's standing between Powell and pausing right now is not actually the CPI reading. It's the labor market. That is why when we had the non-farm payrolls last week, even though the headline number missed, the market focused on the fact that wage growth and the hourly earnings went down, and they celebrated that noise because that fact is more important to the markets right now than the CPI. It doesn't mean CPI is not important, because if CPI comes in high and didn't do what it just did today, markets would have been very upset. They're just assuming it's going to be okay on CPI. Now, the good news when you come into this, I do want to show you, remember, core inflation rose 0.3% month over month. Okay, so you can still see it's running at, the core inflation is still running at 3.6% annualized. So still a little bit high compared to the deflation we're seeing on the headline inflation. But the good news is I did some digging, and you can see that the rent rose 0.8% month over month. Okay, so the rent is still running at a huge rate here. And remember, rent plays a big part of CPI. So we know that the rent figures are starting to come down. All the indicators are showing that there is a lag, and this figure should be coming down. So if we see this renting and shelter start to reduce, that should bring the core inflation in line as well. And then everything across the board is looking pretty smooth in terms of inflation. So then why is the market now showing this? What do I expect to see happen from here? Well, if you look at the Bitcoin chart, I shared this before the inflation figure came out. I mean, you saw that we were running towards this neckline, and we did so before the inflation figure came out. And now we're seeing a little bit of a candle top wick. Perfectly normal. You have a bunch of traders who are playing this right now within the hours around CPI. Let them play that out. What's more important is what happens over the 4-hourly candles and what happens over the next couple of days in terms of this breakout. Remember, the technical target from this breakout sits at the 20,000 level. If you guys want to trade this, you can do so using the links in the description. BYBIT, BITGET, those are the links I use to trade. You're going to get some amazing bonuses, so definitely check them out, and they support the channel if you use those links. Now, I think this could play out to 20,000. Now, when I play these trades, the technical textbook way of doing this is you enter your position on the breakout when you see a good volume. It's decent volume. It's not volume to write home about, but let's see where this volume candle comes in, because we still have 9 hours left of this daily candle. If we drop down to the 4-hourly, you're going to see it a little bit clearer. And what I've drawn here is I'm perfectly fine with a retest. Right? Normally when I take these breakouts, I enter like normally about a third to a quarter of my position. Then I want to top up a big chunk, let's say 50% of my position on the retest. And then when we break this peak, on our way back up here, when we break this peak here where we got resisted, at that point I'd load up the rest of my position. That's the way I like to enter my trades. So I'm perfectly fine with a retest here of the neckline before a bounce up. But either way, I still think this technical price target is in play at 20,000. Do I think it's going to play out immediately? No, there's some work to do. If we look at it from this perspective, we have just managed to reclaim 17,600, 17,800 range. Very important. That was from our summer lows. You guys know I've been talking about that for a very long time. But we have been rejected from this period before, right? We got rejected here during the Jerome Powell conference last time in December. So we need to make sure that we get through this level. And for me, the next milestone, the safe level, right, the checkpoint, will be at this level, 18,700, this green line, which we just need another big push up here. And I think we're about, let's take the measured move from where we're at right now to see how far is that move from where we're at. And you can see that we're about 3.4% away, not a lot. But what that then means is, if I switch over to the daily, is that we could be entering back into that green channel. Very important. This was the green channel. We rode along this, very importantly, for a long time. We fell from Terra Luna, we entered into the channel, and we held at this level. We maneuvered, we tried to run up to 25k, came back down, and we stayed in this channel. Then we started our recovery. And you saw, boom, FTX Sam Bankman-Fried for us straight back down to the downside. So reclaiming this level is very important. It's almost as if we've managed to shrug away what's happened with Sam Bankman-Fried. Even though markets aren't super euphoric right now, they got what they expected, right? 6.5 and 5.7 on the core. In order for the market to go crazy, you had to see a really big beat. You had to see inflation come in at 6.4 or 6.3. We just got what was expected, which is what the market had already priced in. But this is a fundamental shift, and this is what's really important. Going into this year, I was always expecting Q1 and Q2 to be volatile, with Q3 and Q4 showing some room for improvement. I've been doing some real deep dives into all the major global reports, from the likes of Morgan Stanley, JP Morgan, Coinbase, BlackRock. I will be disseminating that data through to our course members, ijaz.uk/member if you want to join those. We do deep macroeconomic fundamental analysis, which just doesn't do well on YouTube. It's boring. So if you want to join us over there, you can cancel at any time. But what the trends are showing is we are expecting a much better year than last year. Last year was a horrible year, guys. We've not seen a year like that since 2008, and many would say it's worse than that. But the good news is we are seeing global trends that show we aren't in the same position as 2008. Mortgages aren't in the same position. The reckless loans are not in the same position. Banks are far better capitalized than 2008. So there are many signs to show that we're in a better position. Also, if we do enter into a mild recession, or we're just going through one right now, it is expected to be a mild one, because this is the best predicted recession we've ever had. We've pretty much known from when the pandemic started to play out that there were going to be consequences. So all eyes have been on this recession. It's not one that's just come out of the blue and shocked us because of some mortgage-backed securities, for instance, like in 2008. So there is a big trend, and now that we're seeing inflation meaningfully start to come down, this is a really good sign. We're in a much better position than we were in last year. Just think about it. FTX collapse, 3 Arrows Capital, Terra Luna, inflation skyrocketing, and then really being stubborn. But now things are starting to improve, right? And that's what's important for us in terms of our long-term positions. We need to say, okay, what is the landscape? And now we're seeing a landscape where CPI is really starting to come down, and that's positive news. We're seeing a market where the wage growth wasn't as high on the last labor report. Yes, Jerome Powell wants to do some more work in terms of tightening up that labor market, creating a little bit more unemployment, even though he won't say it in that way. So there's still some more work to do. But to see that in Q1, and in January, straight out of the bat for the new year, that's a really good sign of things to come. And hopefully, if we can get a pause or 25 basis points and then a pause as soon as Q1, right, by the next meeting in March, that would be a majorly positive start to this year. And I wouldn't be surprised to see risk rotating back on. Now, speaking about risk rotating back on, you can see that the US 10-year, which is obviously where people flock to in times of difficulty, is down 0.65% today. So you're seeing a correction there on the US 10-year. Also, the dollar index is printing a red day, down 0.5% today. And we've seen a meaningful fall here in the dollar index. If I zoom out to the 4-hourly chart, bring out the EMA ribbon, you can see it's getting rejected strongly from its EMA ribbon. And we're seeing a nice big correction here in the dollar index. We are slowly starting to see that people are flocking away from their risk havens and trying to start allocate their capital back in more growth plays. Let's also take a look at how the wider markets are responding. You see the S&P is pretty flat. The NASDAQ is flat as well. So they're not getting crazy excited, right? We are seeing some flatness. You've got a bunch of traders taking profits from the trades in the run-up to the CPI reading. But we want to see how does this play out over the next set of hours and days. In my view, this is a really good jobs report. I don't want us to overlook the fact that this is not positive. We have seen just a major shift now in seeing inflation come down, in now plotting a path where Jerome Powell has no choice but to at least do 25 basis points. So in a couple of meetings, we've gone from 75 basis points. And at the time, remember guys, we were talking maybe he could do 100 basis points, to now having a path to getting to 25 basis points, getting to a pause quicker than we may previously have thought. So if you appreciate this, guys, smash the likes. Don't forget to subscribe. Let me know what you think about this CPI reading. Let me know what are you doing in the market. As always, check out ijaz.uk/TA. Check out ijaz.uk/member if you want to join our member live streams. And I'll see you in the next one.